G'day, Scuddy here. Australia just got a fresh inflation shock, but it was not as bad as markets had feared. Headline inflation jumped 1.1% in March, pushing the annual rate up to 4.6%. That was driven largely by soaring fuel prices and continued strength in housing categories, the largest weight of any in the basket. So on the surface, a very hot report. But the more important detail was found in the underlying measures. Core inflation, as measured by trimmed mean, did not worsen materially. The quarterly read came in at 0.8%, a touch softer than both market and RBA forecasts. That matters because it suggests the first hit from higher oil prices has already landed, but is not yet spread broadly to other parts of the economy. But that is the real risk from here. Markets reflected the softer core detail by trimming the chance of an RBA rate hike next week, but only slightly. Pricing still points to an over 80% probability of a move in May, with another 2 hikes favoured by the end of the year. So Australia still has an inflation problem. The debate is now how much worse it gets in the June and September quarters, and how the RBA will be forced to react. As for the Aussie dollar, it dipped on the inflation data, but the magnitude of the decline was not particularly large. That tells you something important. Aussie US is not trading purely off rates right now. It is trading risk sentiment. There was a strong link with rate differentials between the US and Australia over the turn of the calendar year, as seen in the left-hand pane here. But more recently, it's had a far stronger correlation with risk appetite, proxied on this occasion in the right-hand pane with the S&P 500. The correlation matrix insert confirms what we can see. The link is very tight. That means over the next 24 hours, earnings from Alphabet, Amazon, Microsoft, and Meta may matter just as much, if not more, than the inflation report or Federal Reserve interest rate decision. For the Aussie, Wall Street may decide what comes next.